Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And today we want to go into the murky and difficult to understand world of hybrids. Take it away, Paul.
Well, Peter, a hybrid, as the name implies, is a cross, a bit like the Prius car, which we've had, and we've had hybrid type vehicles
good
around.
Example.
This is a cross between debt or a bond and equity. The debt-like features are it pays a regular distribution. And if you invest $100, you would expect to get $100 back on redemption. So
like a bond.
Like a bond, yep. On the equity side, it's actually classified as capital by the issuer, in most cases a bank. In a wind-up, you rank very near the bottom. So you'd be
like a shareholder.
Like a share, you're not going to get too much money back, if any at all. In distressed circumstances, the actual issue will get converted or exchanged into ordinary shares. And like a share, the security trades on the ASX.
Okay, let's go through the key features so people understand some of the unusual terminology associated with hybrids.
Yeah, there's a bit of terminology here, so let me just go through this. It's an unsecured perpetual note. That means it has no particular, it could go on forever. That's what perpetual means, with a face value of $100. They pay a gross distribution at a fixed margin over a benchmark interest rate. So the benchmark interest rate most of the issues use, Peter, is the 90-day bank bill rate. That's a key institutional rate for 90-day money. And the fixed margin might be 3%. So it's set at the margin is fixed over the 90-day bank bill rate. The distribution's paid quarterly. They're reset each quarter based on the then current 90-day bank bill rate. They're usually franked, but they're adjusted for the benefit of any franking credits. Now, in terms of getting your money back, they have what's called a mandatory exchange. You don't have any choice about this, but on a date set out when the issue is established, you will get mandatorily exchanged back into ordinary shares.
That's if, for example, the issuer decides they want to do a mandatory exchange.
No,
or they have to do
They have to do it. They have to exchange these back into ordinary shares, provided they meet a test. We'll come to that.
Okay.
Typically, that's about 6 to 10 years out. The issuer also has an option when they can decide to exchange or decide to call the issue and give you $100 back. So that's at the issuer's option. That's typically a couple of years short before the mandatory exchange date, about 4 to 8 years out.
Is that more often than a mandatory exchange?
Yeah, most of the issues will get called.
Yeah.
They don't go to mandatory exchange. So mandatory exchange is not necessarily a great outcome.
No.
All right. And the other thing is there's also so-called trigger events. Now, these are things that APRA has inserted into the issue structure so that if the bank gets into serious trouble or, you automatically get exchanged back into ordinary shares. And in that situation, you're probably going to lose a fair chunk of your money. I mentioned they actually count as Tier 1 capital for the issuer and they trade on the ASX.
How about give us an example around the distribution?
Okay, let's take an example. I mentioned distributions, they're paid quarterly, they're at a fixed margin over a 90-day bank bill rate and fully franked and adjusted with the franking credits. Let's assume that the fixed margin for an issue is 3% and the 90-day bank bill is 0.85%. That means for the first quarter, your gross distribution is going to be 3.85%, the 3% plus the 0.85 for the bank bill rate. Now, the actual amount you'll get in cash, if it's fully franked, will be adjusted by multiplying it by 0.7. And so the cash distribution would be 2.7%, but that would have with it all the franking credits.
Which you can use in your tax return.
All right. Now, if on the following quarter, the bank bill rate has gone up, let's say that the market just thinks interest rates are going up a touch or whatever reason, it's risen to 1%, the gross distribution for that quarter would then be 4%. That's the 1% plus the 3%.
4?
Yep. And the cash distribution will be 0.7 of that, which would be 2.8%. If, on the other hand, the bank bill rate has fallen, say, for example, the Reserve Bank might have cut rates or the market's expecting them to cut rates, so expectations have gone down and it's fallen to, say, 0.5 of 1%, the gross distribution will then only be 3.5%, and the cash distribution you get would be 2.45%.
And that's been happening in recent times with the cash rate going down.
Yeah, so these things sort of fixed margin, but they float every quarter over the then 90-day bank bill rate.
Well, Paul, talk us through the exchange, the redemption and repayment process.
Okay, the first one's the mandatory exchange. This is a date that's set when the issue is established, Peter, typically 6 to 10 years out. And on this date, the issuer must exchange provided its ordinary share price hasn't fallen by more than 50% since the time the hybrid was issued. So, for example, Commonwealth Bank has got an issue in the market. Its share price is around about $80. The term of the hybrid is about 9 years. If on that date CBA's share price is more than about $40, it must exchange. If it's less than $40, it doesn't exchange.
And will they keep paying distributions until
Look,
it turns up?
Provided they can,
Yeah.
they will keep paying distributions. What happens, Peter, is that then the exchange is then retested on the next distribution date, and it keeps on being retested until they can exchange. So this thing could go on for a long time, potentially.
Okay.
On exchange, you get back $101 back of ordinary shares.
That's nice.
That's nice. That's just a 1% discount.
Yeah.
There's also an optional exchange or a date when the issuer can actually decide to give you your money back. And this is more generally what's happened with hybrid securities. They've typically, the issuer has issued the option. You get back your $100, or in some circumstances, they give you a chance to reinvest in a new hybrid issue.
Yep.
Now, the really bad situation are what are called trigger events, and there are two of them. There's a non-viability and a capital trigger event. The non-viability is not actually fully defined, but this is when the APRA, the regulator, says the bank is non-viable,
We're worried about
and you must exchange the hybrid securities into ordinary shares to actually get a stronger capital base. Or a capital ratio event is when typically the bank's capital ratio falls below a level, normally about 5 1/8%. And again, automatic exchange would occur.
Who determines what amount of shares you get, Paul?
Well, the maximum number of shares is actually set at the time of issue. And if either of these events to occur, Peter, you're probably going to get back shares that are worth a lot less than $100. So in those situations, I think you could have on paper losses of almost up to about 80%.
Gee. All right, Paul, you've explained it all pretty clearly. So how do hybrids rank in this whole process if things go wrong?
Again, look, just to add to a bit of not the worry factors, but they rank pretty lowly, pretty close to the bottom, just above ordinary shares. This is a description or a diagram that the Commonwealth Bank has for a current Pearls 12 issue. And you can see hybrids rate sort of near the bottom. They're behind all depositors, they're behind the tax office, they're behind all unsecured creditors. You know, for example, a local branch might buy milk off a store.
Yeah.
That gets paid out first. All those things paid out first before any money would flow to the hybrid security holders. So if the bank is wound up, usually would be in as distressed circumstances.
Yeah. And I don't think any of us want to talk about banks being
I don't
wound
think
up.
you're going to get your money back.
Okay, so let's talk about the risks.
Okay, look, it's not a bank deposit, most importantly. There's no capital security. It's not covered by any government guarantee. We've mentioned that. We've mentioned also if the bank gets into serious trouble or there's an issue in Australian banking crisis, you could lose some of all your capital. A trigger event, we talked about an automatic exchange, and as the maximum number of shares is capped, the value could be materially less than $100. The one other risk, Peter, is that distributions are discretionary. So there's actually no obligation on the issuer to pay you the distribution, and they're also not cumulative. That means if they don't pay it, they won't subsequently repay them. Now, there's a little bit of protection. There's what's called a dividend stopper. So if the bank decides not to actually pay a distribution on a hybrid security, it's not allowed to pay a dividend on its ordinary shares. And I guess that would be a pretty negative signal to the market.
That's
so
right.
the discretion here is probably not going to be misapplied.
Yeah, and the desire for an issuer to mistreat someone who's gone into hybrid would be really low. They wouldn't want to do that for brand reasons. Okay, I think the most important question I want to ask you is, Paul, are you invested in hybrids?
Look, I am an investor in hybrid securities. I like them. I think that they actually can, for an important part of what I treat them as sort of fixed interest, and I think of them as risky fixed interest. That's not to say we shouldn't have risk, we should. But most importantly, Peter, I think it's really important to understand these issues because they are complex.
Yeah.
And so read very carefully the prospectus or any offer document. And also, look, if you want to know more, ASIC has a really good website on its Money Smart website, has a course around understanding hybrid securities. And I'd strongly encourage you to have a look at that first if you've got any questions.
That's Switzer Investing Insights, brought to you by nabtrade. Thanks for joining us.